Over the last day, there was a clear break in the silver market. Physical silver printed above $100 in a big Asian pricing hub, but the spot price in the West was much lower. It should have closed up quickly. It wasn't. And when a gap that big won't close, it generally means one thing. The pipes are clogged, the metal is tight, or the rules are being changed behind the scenes. So this is what really happened. There was a physical standard in Asia that went over 100. And almost at the same time, trade in the West was in the low 90s. Most of the time, dealers will jump on that spread. Shipments move, paper bends, and the gap closes. The gap wouldn't close, though. It stayed open. You should pay attention to that kind of warning because it means the price you see on paper is not the same as what people are paying for real ounces. I need your help with something before we go any further. I'm going to keep it simple. It's my goal to get rid of copycat stations that use the same talking points, clips, and stories over and over again and call it original analysis. To help the original work here, please subscribe right now and leave a comment that says OG John AG. That one comment is more useful than you think because it tells the script where the real community is. Because this effort is about getting real people to follow you. I also made a WhatsApp channel for people who want daily updates, short notes, quick alerts, key ideas, and things you'd rather see early than late. There is a link in the text. If you want to make money in this market, you need to get in now. Okay, let's go back to silver. The story gets weirder as you look into it more. Silver prices aren't just going up when they trade above $100 in a big hub. It means someone is ready to pay a lot to get metal right now. Not next month, and not a promise right now. When the Western price falls at the same time, it makes you wonder why metal isn't moving like it used to. A lot of people like to say that every spike is just hype or guesswork, but this doesn't look like a normal blow-off. Open interest is one of the best ways to tell. Many times in the past, when there was a hyperbolic move, there was also an increase in open interest. This means that there was more borrowing, speculation, and adding of paper. But when price goes up and open interest goes down, it usually means that shorts are closing and risk is going down, not that a lot of new paper longs are being bought. That is, the pressure might not just be from gamblers hitting buttons, but also from real people wanting to leave and being forced to. This is more important than most people think because it has to do with something that happened on the stock side. During the middle of this rise, big clearing pathways made it harder to buy some smaller mining stocks. Be careful with the word. It basically said that you can sell or unload, but you can't buy if the company is too small or the price of the shares is too low. Read it again. It's okay to sell. It's about buying. That would be wrong in a truly free market. You already know it. Next, ask the clear question. Who do you sell to? Since the public is being pushed to sell, someone else is quietly getting ready to buy. That's how re-ratings and squeezes are made, not with an air trumpet. Where it matters, with friction. That way, the easy money gets in first, and the late money gets what's left over. Now think about what that means for teenagers who work as junior miners. Tales of pure discovery are not the same as stories that want to start over. There is hope and digging among explorers. This is because restart plays are known mines with a better path. Licenses, money, tools, and making things. When silver prices rise quickly, restart plays can change prices very quickly because the market starts to price future cash flow instead of guesses about the future. So, if entry is limited, just as silver prices are going through the roof, you have to wonder if this is risk management or just keeping people out before the crowd comes in. In this case, the candles on your chart are not always the most important hints. Those are the things people do around the market. There are signs when spreads stop closing, stocks drop, access is controlled, and the story turns into an organized chorus of warnings. At those times, the system is trying to keep track of when people are participating. People lose money most when they don't know when to act. Now, people in the silver world have talked about renting and borrowing. The weird part comes next. In a real physical squeeze, you would expect the cost of getting money to go through the roof. If there isn't enough metal, the cost of borrowing should go up, not down. So, if there are signs that interest rates are moving away from very high levels, while physical tightness is still clear, you should think that the signals might be being slowed down, smoothed out, or made less useful. It's not true that any one number proves anything. I'm saying that the trend fits with what systems do when they are stressed. They try to look normal until they can't. Then you look away and see something else. Securitying strategic minerals and supply lines is becoming a more open topic of conversation among governments and big financial players. That's important because silver isn't just used for coins and jewelry. Silver is used in medicine, electronics, energy technology, the military, and as an industry input. It's easy to understand. The world will pay for it if it needs it. When people all over the world bid on something and there isn't enough to go around, paper promises become a problem. This is the part that makes people feel bad. So, please think about it. On paper, crazy amounts of silver can be bought and sold without moving a bar. That only works if physical can be found when it's needed to fill in the gaps and meet responsibilities. If real gets harder to find, the price on the paper is less reliable. It turns into an idea. For that reason, the market doesn't move to a new balance. It jumps. Take note of the mental whiplash as well. One day, someone tells you that silver is dull, old, and worthless. The same people yell the next day that it's dangerous, too hot, and about to crash. The flip-in question is not analysis, it's crowd control. That's why it's set up that way, to sell strength, chase weakness, and always feel late. Do not play that game. That you're puzzled is the point, and it works today. Now, I understand what some people think. It's over $100 somewhere, so why doesn't everyone just trade it everywhere? Thanks for the question. No, arbitrage is not a magic wand. Arbitrage needs transportation, approvals, inventory, and willing counterparties who are ready to do business. There could be a gap if the metal can't move easily, if it's already been taken, or if new approvals slow down the pipeline. And gaps that don't go away aren't a sign of speed. They mean you're stressed. For now, let's talk about stocks, as this is where the story really starts. It's not a chart trick when stocks that can be seen in important places start going down while prices are going up. That's metal going off the shelf. The supply is being pulled out of the system by demand. And the paper comfort goes away if supply is cut off faster than it can be refilled. Because paper can quickly get bigger. The physical can't. Now, I want to talk about the culture of rumors that always goes crazy at times like these. People will say that there are huge short positions, hidden reports, emergency meetings, and that someone is about to blow up. Some of that doesn't make sense. Some of it is mostly true. At least some of it is misleading. But here's what's important. Just because one rumor is true doesn't mean that the underlying risk is real. It's hard to get out of a market that's getting tighter if a big player is structurally short. They can give you the metal, buy it back at a higher price, or try to settle for cash and hope no one sees. Those choices look doable when markets are calm. When markets are tight, two of those choices hurt, and one is bad for your image. That's why the next part of the story isn't about what silver should do. It has to do with what the system can handle and what it will do to get more time. Another reason for this is that actual holders are in a special place. If the system needs metal to ease stress, then physical is the way out. You should know what you own and why you own it. If you use physical to protect yourself over time, you don't let a story shake you up. You take care of it like a trade if you hold it as a trade. Don't mix them up at the worst possible time, though, because that's when guilt starts. And let's be honest, this is when the market tries to trick you. The price goes up and up. Fear comes back in a new form, and all of a sudden, the same people who laughed at silver at $25 start telling you that $90 is too much. This is how people get ready for the next step. It's always the same trick. Make you question your plan just as it starts to work. After that, buy what you offered. I'm about to do something that not many stations will do. I'm going to ask you to take part. Comment on physical leads if you believe that the triple-digit physical print is the real price and the Western spot is just a trick. It's a tie if you think the Western spot will bring everything back down. I'm interested in where this audience stands because the comments show how they feel, and how they feel is important in a pinch. Now here's another question for you. How do you think that gap is being kept open right now? Are there limits on movement, real shortages, or planned management? Pick one and explain why. If you're right, you'll have a plan that you can use when markets go up and down again, which they will. Now, let's take a short break because some of you asked for inspiration and images from real life. There's a link in the description to a station that does nothing but success stories about silver. Go sign up there too. Because hearing about real people who made money can keep your resolve strong when the market tries to shake you up, and it serves as a reminder that waiting pays off. Let's go back to the basics. There is another warning that is bullish but risky. There is room for the move when prices go up and speculators aren't fully involved. How do you know what will happen when momentum traders finally buy in when open interest is down and the rise is caused by industry demand and short covering? During that time, things can speed up in a way that changes the rules of the game. You can make a lot of money and lose a lot of it during government changes. If you think that sounds extreme, think about how things work when they are stressed. First, there are small changes to rules that are called risk limits. Then you see problems with access. After that, you'll see selective limitations. The story then changes from nothing to see here to extraordinary measures were needed when the pressure is too great to hide. The breaking point isn't announced ahead of time by the markets. They show you the signs, which are in the spread right now. Let's talk about miners once more to help you understand how the game works. Big makers can move, but because institutions already own them, they do so more slowly. You can get a good mix of cash and torque from mid-tiers. Juniors can be very useful, but they can also be hard to get to. There is danger in financing and brokering. There is an access risk in a market where buying limits are possible. It is part of the deal. Just picking a good story isn't enough. It's important to know what to do if the gate gets half closed at the worst possible time and the market changes. This is another reason why some people choose to lower their debt even though they are still bullish. When volatility is high, it can wipe out option holdings, even if you are right about the long-term direction. The market can really swing against you before it starts to move in your favor. When you use leverage, you need to be aware that time is everything. To make the theory pay, you need to stay in the game for a while. Now I want to get back to the main point of today's story. The persistent difference in prices between Asia and the West for real goods and paper goods is a warning sign. If that spread stays the same, the market is telling you that real is worth more than paper. And if something is considered less than paper for a long time, paper has to catch up to the physical thing, not the other way around. That's when the chart stops moving in straight lines and starts moving in steps. This leads to the most exciting ending of all. What happens when the Western market has to face the fact that silver is already selling in the triple digits as a physical benchmark? To close the gap, does Western spot jump? Are we going to see more rules that make it harder to participate? Do we hear that the words cash settlement are being used? Or do we see a rush for concrete that makes the paper system too busy and changes the rules? Because the next story won't be nice. It's going to happen quickly. And it will make people wish they had paid attention when the signs were smaller, the gap was smaller, and the reasons still made sense. So, this is my message to you. Pay attention to the rule changes, the inventory draws, the spreads, and the open interest. There is more information in those 4 things than in any picture. And if you want to stay in this for a long time, make a plan that you can follow without stressing out. Stress is a fee that people who planned have to pay. Also, I want to say this again because community is important. If you're doing well in any area of your life, share a short success story in the comments. Don't do this to brag, but to encourage other people. When people see real examples from real viewers, it makes everyone in the group think more positively. And if you're not there yet, tell us what you're at. The comments should be a place where winners help each other out and where newbies can get real support. You already know this isn't just another silver rise if you've watched this far. Prices that are going up by 3 to 10%, a gap that won't go away between East and West, falling open interest during a surge, and entry restrictions in key parts of the stock market are not normal. They are the parts of a market that is changing from being managed to being chaotic. And markets that aren't regulated don't move slowly. They move like a door that will soon break. Do the easy things now. Sign up now, because in this market, the next update could change everything in an instant. Also, leave a comment OG John AG if you back the effort to get rid of copycats. So the site knows who you're backing. Then join the WhatsApp group in the description to get daily updates, because being early is always better than being grumpy. There is one more question I want to ask you, and it is important. If silver in the real world is already being bid above $100, what do you think the paper market will look like when it can't ignore that warning any longer?